In this video, we're going to talk about Type A tax-free reorganizations. So first, we're going to talk about the structure of Type A reorganizations, and then I'm going to talk about the rules that are required to qualify for a Type A reorganization, and then we're going to close with an example. So first off, Type A could be either a merger or a consolidation. And technically, you could also have a Type A reorganization with what's called a forward triangular merger, in a reverse triangular. We're not going to talk about that in this video. We're just going to focus on the mergers and consolidations, and we'll talk about the triangular types in another video. So with a merger, what you have is you have the purchasing corporation. When they are acquiring the target is merging into and becoming part of the purchaser. So there's not going to be any more target. All the assets and liabilities are going to be consumed and become part of the purchaser, and so you will have one entity. Now with consolidation, what you have is you've got, again, a purchaser and a target, obviously, but now they're going to create this other company. So we'll call this company three, and so they are going to be consolidated. Both of these are going to become part now of this new company, company three. So you've got mergers, you've got consolidations. So the rules can be a little restrictive, and one of the reasons is that with a Type A reorganization, you have to follow the state's merger and consolidation laws. And what does that mean? So, well, one of the things that might mean is, so a lot of states have where you actually have to get 2/3 approval from the shareholders in order to be able to go through with the deal. So if you can't get 2/3, then the deal could be blocked, and you're not even able to have the reorganization. And now, also, what this is kind of an advantage of the Type A, though, is that you get a lot of flexibility. So it's very flexible in terms of the consideration given. So even though you have to follow these merger and consolidation laws, when you're determining, well, what am I going to pay for this target? If you're the purchasing company, it's very flexible in that voting stock only has to be at least 40% of the consideration being given. So if you're giving, let's say, $1 million for the target, then at least 400,000 of that, 40% of that consideration, has to be voting stock of the purchasing corporation, right? So the purchasing corporation will give this consideration, 40% of which is their own voting stock that's being given to the target, so that the target's shareholders will have this thing called continuity of interest in the new entity, which we'll talk about more later. So another thing, though, and this is a disadvantage of the Type A reorganization, is when you're acquiring the target, you're going to get stuck with all of their liabilities. So if they have some contingent liabilities or something that you're not aware of, maybe some kind of environmental damage that they did and you're not even aware of that, when you get this new entity, you're going to be stuck with all of their liabilities. However, one advantage is that before the deal goes forward, before you do the deal, you could have the target sell off any unwanted assets. Now, again, that's not going to protect you from these contingent liabilities that you might not know about. But if there are certain assets that are part of the target, there's a division that you don't really want, the target could sell off those assets, and then you go ahead and you do the Type A deal. Now, another disadvantage of Type A is that the dissenting shareholders, so any holdouts who don't want to go through with the deal, they can demand that their shares be appraised and that they be purchased by the purchaser. And so you could have issues with some holdout shareholders. And also, another disadvantage is that, so if you're doing the merger, that it could require basically certain properties like a lease or something, maybe a lease agreement, and they're supposed to be transferred as part of the merger, but they might be non-transferable. So there might be some legal issues in terms of certain properties or patents or something like that. So I just want to walk you through kind of a short, simple example to give you an idea about how a Type A reorganization would go. So let's say that you run the purchasing company. So this is going to be a company doing the acquiring. It's called Amazing Animals, right? So you are the CEO of Amazing Animals, and you want to do a Type A reorganization. You want to acquire turtles and things, right? And so let's just leave aside now whether it's a merger, consolidation, and so forth. We already talked about the form. Let's just get into the specifics of the fact that you are paying, in terms of consideration, you're going to pay roughly $2 million. 800,000 of which is voting stock of Amazing Animals, and then 1.2 million of cash, right? And so we see that the voting stock is at least 40% of the total consideration. Total consideration is $2 million. Voting stock is $800,000. So we've met that requirement. Now, first of all, if you're just wondering, well, why are we even paying $2 million? So if we look at Turtles and Things, they have the assets. They have fair market value of their assets is $3 million. And then they have liabilities of $1 million. So that really would just say that the fair market value of this firm is $2 million. Okay, so now they also have, let's just say to make it simple, the Turtles and Things has one shareholder. They have one shareholder, and that shareholder's basis in his or her stock is $500,000. And that's going to become relevant when we're trying to figure out the implications of this transaction to the shareholder of Turtles and Things, right? So what is going to happen is you're going to give the voting stock and the cash to Turtles and Things. And then Turtles and Things is going to give they're going to distribute it to their lone shareholder. And then all the assets and everything are going to be merged or consolidated with Amazing Animals, right? So basically this Turtles and Things is going to cease to exist, but Amazing Animals is going to get all their assets, right? So the target, and now I want to talk about the target, I'm going to talk about Turtles and Things, the corporation being acquired. They're going to have a realized gain, not a recognized gain. Remember the distinction, right? So a realized gain, we think of, well, what is their amount realized minus their adjusted basis? So they are basically giving up 800,000, or they're receiving 800,000 of voting stock, 1.2 million of cash, and then 1 million of debt relief because they've got $1 million of liability. So that's their amount realized minus the adjusted basis of their assets of 1.2 million. So we subtract that and we see that the realized gain for the target is $1.8 million. However, because this qualifies as a Type A tax-free reorganization, the recognized gain is going to be zero. So the recognized gain is zero. That's very important. That's the whole idea of the tax-free reorganization, is that they are not, even though they've got a realized gain, the recognized gain is zero. So there's not going to be any tax liability to the target, right? So that's nice. Now let's think about the target shareholder, right? So this shareholder, so again, the voting stock and cash are being given to Turtles and Things, but then Turtles and Things is turning around and giving that to their shareholder, right? And then Turtles and Things is basically going to cease to exist. So the target shareholder is going to have a realized gain, and the recognized gain is going to be different, but let's do the realized gain first. So the realized gain is going to be, we're going to look at the amount realized, 800,000 plus 1.2 million, because that was given to Turtles and Things by Amazing Animals, and the Turtles and Things turns around and gives it to their shareholder. Right, so there's $2 million the shareholders are receiving minus 500,000, which is the shareholder's basis in his or her stock. Okay, so that means the target shareholder has a realized gain of $1.5 million. Now, how much of that is going to be recognized? Well, we've got this thing here where we have boot. We have boot being given. So if the target shareholder was just getting voting stock and that was it, then we wouldn't have to worry about a gain. It would just completely be tax-free on the shareholder's part. But there's some boot, there's some non-voting stock in here, and it's $1.2 million. So what we're going to do is we're going to look at the lesser of the two. So basically, this boot, this 1.2 million, will be taxable to the extent there's a realized gain. So there's 1.5 million of realized gain, so the entire $1.2 million of boot is going to be recognized gain to the target shareholder. Now let's just pretend hypothetically. Let's just say that the realized gain had actually been $1.1 million. Well, because this boot is only taxable to the extent of realized gain, then it would not be 1.2 million of boot gain. It would end up being $1.1 million of recognized boot gain to the target shareholder.